Hey everyone, welcome back to Corporate Decoder, the place where we dig through corporate filings so you don't have to. Today we are decoding Bridgford Foods' latest quarterly report. Let's see if their results are half-baked or fully cooked. Before we dive in, if you enjoy straightforward insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below so you can chat with other Corporate Decoder fans. This report paints a mixed picture for the company known for its frozen dough and snack foods. Sales are up slightly, but profits are down. We'll break down the key numbers and see what's really going on under the surface. First, a quick company overview. Bridgford Foods is a California-based company trading under the ticker BRID. According to this report filed for April 18, 2025, they have just over 9 million shares of common stock outstanding. This is their 10Q report, which is basically a quarterly check-in with the Securities and Exchange Commission, or SEC, giving investors an update on how the company is doing every 3 months. It's not a full audit like the annual 10K report, but it gives a good snapshot. Now, let's get to the numbers. The balance sheet shows what the company owns and owes. We are taking a look at their most recent period compared to November of last year. Their accounts receivable, which is the money owed to them by customers, is sitting at about $27 billion, a bit lower than last November's $34 million. Now, inventories, the value of their raw materials and finished products, are up significantly, sitting at around $40 million last November. That could mean they are expecting higher sales, or they might be having trouble selling what they already have. We'll need to dig deeper. Property, plant and equipment, their long-term assets, are at $63.1 million, slightly down from last November's $64.6 million. Overall, their total assets are down slightly. From $157.3 million, it means there has been some adjustment somewhere. On the liability side, accounts payable, what they owe to their suppliers, is up to $7.7 million from $5.6 million. That suggests they might be taking longer to pay their bills, or their costs have simply gone up. Total current liabilities, their short-term debts are $19.5 million November. Total long-term liabilities are $9.7 million now, down from $12.7 million, now down from $12.7 million. Total shareholders' equity is sitting at $128 million, down from $128.1 million. This decrease is a reflection of the losses they have incurred recently. Now, let's move on to the income statement. This shows how profitable the company has been over the last 3 months and 6 months of this fiscal year. Net sales for the last 12 weeks are $50.6 million compared to $47.3 million for the same period last year. So sales are up, that's good news. Looking at the 24-week period, sales are up just a bit at $103.1 million versus $102.1 million. Unfortunately, their cost of products sold is also up, eating into their profits. 12-week cost of sales is $39.5 for 36.5 million, and for 24 weeks that's $79.2 million versus $35.3 million. Their gross margin, the difference between sales and the cost of those sales, is $11 million for the last 12 weeks, a slight increase from the $10.7 million from last year. The 24-week gross margins are down, however, at $23.9 million versus $26.7 million. Selling, general and administrative expenses, the cost to run the business, are also up a bit at $14.2 million from $13.9 million. That leaves them with an operating loss of $3.1 million for the quarter versus a $3.2 million loss last year. Zooming out, the operating loss for the 24-week period is a hefty $5.1 million loss versus $2.2 million last year. Ultimately, their net loss for the quarter is $3.8 million versus a $2.1 million loss last year. Over 24 weeks, the $4.9 million net loss is significantly worse than the nearly $1 million loss in the prior period. That translates to a loss of 0.43 cents per share compared to a loss of busy $8 a year, showing that profitability is decreasing. The statement of shareholders' equity basically shows how the ownership of the company has changed. Nothing too exciting here, just a reflection of those losses we just mentioned, decreasing retained earnings. Next is the statement of cash flows. This is super important since it tells us how much cash the company is generating or burning. Net cash used in operating activities is negative $5.4 million. This means they are spending more cash than they are bringing in from their core business activities. Compare that to last year where they had positive cash flow of $1 million in the same period. That's a concerning change. They used $1.5 million in investing activities, mostly buying property, plant, and equipment. Net cash used in financing activities was about $979,000. They're paying down some debt. Overall, cash and cash equivalents decreased by a substantial $7.9 million. They went from having $10 in the bank last November to just $2.2 million now. That's a big drawdown. Now, skipping past a lot of the accounting jargon, let's look at customer concentration. This shows how reliant they are on certain big customers. Walmart accounts for nearly 30% of their sales and 25% of their receivables. Dollar General is also significant, with over 14% of sales and 24% of receivables. Losing either of those customers would be a major blow. There are some expected changes to how they have to report certain information, but these are in the future, so no immediate effect. They have an equipment note payable for $233, and the report emphasizes they are in discussions to either amend or renew their credit agreement because they are currently not meeting the financial terms of their loan agreements. A violation of such agreements can be concerning. It may affect their ability to borrow more money. And that is it. So what's the verdict here? Bridgford Foods is facing some challenges. Sales are up, but costs are rising faster, leading to bigger losses and a shrinking cash pile. They're relying heavily on a couple of key customers and they're not meeting their debt covenants. On the bright side, they're trying to innovate with private label arrangements and are tackling their cost problems head on. A key opportunity is that consumers are more budget conscious right now, driving demand for private label, frozen and snack foods where Bridgford competes. However, there are big risks such as commodity cost, supply chain issues, and how the consumer responds to price changes that are hard to foresee and control. Ultimately, I'd say Bridgford Foods is at a turning point. They need to get their costs under control and continue to grow sales to secure their financial future. It's not game over, but they definitely need to bring their A game to the next few quarters. What's your take on Bridgford Foods? Drop your thoughts in the comments. If this analysis was helpful, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.